All right, welcome back to the paper. This is episode 7. Today we have a finance exclusive episode for you guys. So I kind of went nuts in my section and ran over our allowed time. So this is just going to be the finance section. We'll have the entrepreneurship section and the personal health section coming later in the week for you guys. So stay tuned for those.
Good
All right,
stuff
so
to
let's
know.
jump into it. I guess I just kind of pulled up the ETF page on Investopedia, like ETF basics, and I'll just read this quick little spiel about what an ETF is. So it's an exchange-traded fund, ETF, is a type of security that involves a collection of securities such as stocks. It could be bonds as well. There's bond funds, things like that. But most of the time it's stocks. It often tracks an underlying index, although they can invest in any number of industry sectors or use various strategies. ETFs are in many ways similar to mutual funds. However, they are listed on exchanges and ETF shares trade throughout the day, just like an ordinary stock. So, for me, the best way to think about an ETF is, like it said, like a mutual fund. So they kind of pool together a bunch of money, then they go out and buy specific securities depending on like what their
Investment strategy is like.
right, yeah, or like what their kind of prospectus
Mhm.
or like what they basically set out to do. So like, for example, the easiest one I can think of right now is
Their mission.
the Jets ETF because I own it. It's JETS is the ticker, and as you could probably guess, it holds airline stocks, like strictly just I think all the ones you think of: Delta, Southwest, American, and then there's a couple other ones, but it's pretty evenly broken up. But yeah, I mean, like there's a bunch of different ones. There's obviously like all the index trackers, tracks like the S&P 500.
Yep.
You can do
The
like a
Dow.
total market one. Yeah. Yep. The NASDAQ, which is going to be more tech focused. But then I think we talked about this a little bit last episode. You can just get into ones that are very, very like niche. So like if I want tech stocks specifically, there's an
Mhm.
ETF for that. So it gives you a
Yep.
lot of ways to like increase your exposure to different industries or sectors.
Yeah, and diversification also, because there's ones that are like just real estate ones. I think that's
Hmm.
XLRE is one of the funds.
Yeah.
So, I mean, like you said, one that tracks the total market, you're going to have various different companies through different sectors and that. So that kind of diversifies your portfolio.
Right. It kind of is a way to diversify without owning a lot of different things. I mean, you kind
Yeah.
of indirectly own a
Yeah.
lot of different things, but you don't necessarily have to have like 18 holdings in your, or 20 holdings in your portfolio to be diversified. You could have
Mhm.
that one ETF, and through that, you kind of hold
Yeah.
18 other
And
things.
then also another pro of ETFs is being able, like you said, exposure to different companies, but also the ones that you normally wouldn't be able to afford, like Amazon. Like
Right.
you can't, like you. I'm not saying you can't, but
Yeah.
it's not likely that just the average retail investor has the capital to just go buy one share of Amazon, and then
Yo,
it's
or
like
Tesla,
only one share. Exactly. Yeah, that boom.
especially since Tesla's like $1,600
Yeah,
trading. Probably, I forget what it closed at today, but
I
yeah,
think. Yeah,
that's a really good point. Is if you want that kind of exposure to,
yeah.
like, Amazon would probably be considered like tech, but they're obviously a conglomerate. But
Mhm.
yeah, I mean, the main point you're making is like you can get exposure to things that you wouldn't or normally just by holding their shares.
Exactly. Yeah.
Is there an
Um,
ETF for the FANG stocks? Like
yeah, I think there's like a tech one. That's the thing. So there's not going to be it's not like you can go out and find an ETF that has like Facebook, Twitter, and what's another, Microsoft. Like there's not this like specific ones like that, but like if you go kind of like a level above that to where it's like an industry or like a specific market, like you could do like there's probably like a developing markets one.
yeah, like you can probably do that with like Vanguard or like the S&P 500, one of those ones.
Yeah, if you type in developing markets into Google, it automatically pops up with ETF. So there's like Schwab emerging markets, the Spider portfolio emerging markets, iShares, MSCI, which is I forget what MSCI is. But yeah, I mean, like you just have to kind of comb through and figure out what, first of all, like what you want to be exposed to, and then like kind of pick an ETF that fits that well. Um, so
Yeah,
yeah,
because like you can really get very niche on the ETFs to where
yeah,
it's like, say you only want to invest in like green companies or something, there's
yep,
a chance that there's a fund out there because it's just a pool. A fund is just a pool of resources, a pool of money. So if
right,
they create enough, capital or resources to establish the fund, they can go ahead and set one up and invest in the companies that fit their, like Costa said, prospectus.
right. Yeah, you remember those commercials where I don't know if it was for Apple or something. I think it was for Apple, but you know those commercials where it'd be like they'd be doing something and then they had a problem and it would be like the like catch line was like there's an app for that.
Hmm.
You guys remember that shit?
Hmm.
Yeah,
No.
that's what it is like with ETFs. Like
There's an
there's an
ETF for
ETF
that.
for pretty much everything. You
Yeah.
know, that's what it reminds me of because there's so many of them and they're really, really popular because of like all the pros that we've like laid out. Like you can spread your risk around. Um, you can
Too
get
bad.
exposure to things that you normally wouldn't be able to get
Mhm.
exposure to. So like, you know, there's tons of them and they're really pretty popular today. Um, but yeah.
Yeah, because like when you're invested in like you're invested in the fund and it has so many different holdings, maybe one company is doing really well and like a couple might have taken a hit, you're not really gonna feel that on your portfolio as much
Right.
as
Yeah.
opposed to like normally over time, like especially ones that track the total market. Like if you would have just, well, we're gonna also cover dollar cost average over that time, you would have been able to create really good gains.
Right.
So that's what investing is about, is investing early and investing often. And we'll cover that more in the dollar cost averaging portion.
Yeah. Um, yeah, I don't want to get like too ahead because I think there's still some
Facts.
more stuff we could talk
No,
about
yeah. Yeah, I'm talking
ETFs.
about.
But yeah, so like some cons I guess we could cover would be like sometimes they have management fees. So like if you go out and buy again like Microsoft, Facebook, Twitter, like there's no fee for that. Like they're not going to charge you money to manage the fund basically. But some active ETFs will have like management fees or anything or stuff like that.
And that's
Um,
called the expense
expense
ratio.
ratio, yeah.
Yeah.
So you just have to like look up the ticker on maybe like Morningstar, or just Google it, and
Yahoo
it'll probably
Finance.
lay it out. Yeah. So that's a big thing about that. Um, I guess like we could talk a little bit about what we each use them for. So like me personally, I like to my strategy is kind of like, and I don't want to get like too in depth or anything because I don't want you know to confuse anybody or anything like that. But like
Hmm.
you can use ETFs. What I like to use them for in my like kind of like brokerage account, my like personal one that I do with my two other cousins, we use them for like so like ETFs make up like the core of our portfolio. So I'll like I own like I don't want to get into my holdings, but I'll own like a bunch of ETFs that kind of track the market or like indexes, whatever. And so that
Indices.
kind of gives me a solid like base. Then on top of that, you can kind of branch out into like, maybe you want to own like a couple penny stocks or you like got a tip about this thing, you like have some extra cash on the sidelines. You want to put that in there just to see like, maybe it hits, maybe it doesn't, um, but as long as you kind of have that core like ETF built portfolio, it's gonna generated pretty decent return on top of like all the other stuff that you do. So maybe you can have like VTI, which is the total index, total market, and then like maybe VOO, which is the Vanguard S&P,
Yeah.
and then a couple other ones, and just have that as kind of like, that's sort of the inner circle. That's like your base. And then on the outside, you kind of have, maybe you hold like Facebook, or you hold like Twitter, like I said, Twitter, or like, you know, a bunch of single stocks that you like, kind of like the prospects for, or something like that. That's one way to use ETFs to your advantage, because it gives you that kind of baseline. I'm not sure like how you guys use them, but that's just me.
Yeah, so I'm invested in what is called a dividend aristocrat,
Okay.
or I'm invested in a ETF that is, so like we said, ETFs can really be tracking anything like indexes or sectors. There can also be an ETF of dividend aristocrats, which are companies that paid a dividend or increased their dividend by every year for like 25 years. So it's like a fund that invests in those type of companies. And so that was one of my strategies in investing in that company, was to try and get an income kind of from it. And because of the fact that they pay dividends and they track companies that do pay dividends. So that was my strategy behind it, as well as the appreciation of them, because a couple of them have risen in the share price. So that's also another profit generation right there. So
Now,
yeah, and that,
do you take the dividends out, or are you kind of
no,
like
drip,
yeah.
big
Okay,
drip.
yeah. That's what I was gonna say. That's one of the things. I think we covered this in an episode, or maybe I've seen you
We've
post
mentioned
about
it.
it. But like a lot of investors will take dividends that are either paid from, like, obviously in your case ETFs, or like just stocks in general, and
Yep.
just like automatically enroll their portfolio into what's called a drip, which you mentioned. So it's
Dividend reinvestment program or something.
right.
The P
Yeah.
stands for something like that.
Yeah. So, yeah, and that just takes a dividend and then buys more. So
Yeah.
you just keep buying.
Reinvest. Exactly.
There's a
as it
lot
sounds.
of charts that you can look up, or like studies that have shown that your return is like a lot more, like significantly higher, if you reinvest the dividends. So some people like to take them out. I think we've seen some people, at least I have, like just on social media, talk about how the dividends can be used to like kind of pay bills, or different ways to use that cash, which is fine if that's like what you want to go for. That's totally cool. It's all like personal preference, obviously, but you kind of sacrifice owning more. You know what I mean?
Yeah.
If you
But
don't
it
enroll
just
in that.
all comes back to your investment strategy and your investment thesis, what you're really looking for, and if it's in line with like your objectives. Every investor is like different. So
Definitely.
yeah.
Yeah. And that's
But
definitely
that's great
something.
advice though, because reinvest, especially if you think the ETF is solid for the long term. It's not always about that instant gratification,
Right.
because that growth, that compound effect over the years, if you just keep reinvesting it, is gonna be more than if you were to just take the
Definitely.
income out. Unless it's to put it into like another asset or something, you should probably just reinvest it. Not financial advice.
Yeah. Yeah, for real. We should make that disclaimer, as we always do. But yeah, like I forgot what I was gonna say. Oh boy. Yeah, I mean, so we've covered a lot with ETFs. It's a lot of information that we're kind of throwing at you, but just know that there's a ton of them out there. You want to kind of look through them. There's a bunch of them that are like very, very similar. Oh, so we can get into this too. This is something that I've been learning. I actually just started my internship with Plant Moran this past week.
Congratulations, my boy.
Thank you, appreciate it. But we've been kind of discussing a lot throughout the trainings and everything about tax loss harvesting, which is something that you can do with ETFs and or mutual funds. So this isn't really the point of the episode, but we might as well get into it. Essentially what tax loss harvesting is when you own, say, the VOO, which is something I mentioned earlier, which is the S&P 500 index ETF. And it goes down. So like you have a day in March where the whole market's down like 7% or whatever it was in one day. So what you can do is you take that S&P or that VOO, you sell it at a loss. So kind of a little counterintuitive. So you lock in that loss. So let's say you owned it at 100, it went down to 50, which is terrible. That's terrible return. Hopefully that never happens to you. But if it does, there's a benefit to it. So you can, this is a way to kind of create a benefit out of a loss. So it goes down to 50, you sell it. So right now you have a realized loss of $50. Then let's say you buy another one like the SPY. It's very, very, very similar in the holdings. Those two ETFs are basically the same thing. So you have to find something that's very similar. You buy that second one, and then that goes up to, say you buy that at 50 and it goes up to 100. Then you have $50 of capital gains, right? So you can either lock those in or you can just hold it, hope it goes up more. And then what you can do is kind of net those two and not have to pay any capital gains tax on the $50 like spread basically. So there was a lot of that going on in March because, like I said, the market tanked like 35% or something like that. And it's a way to, like, you know, when the market tanks, it's a way to get something positive out of it, I guess. Obviously, you don't want your investments to go down. That's not really ever good, but there are ways to sort of like create something good out of it.
Silver lining.
Yeah, exactly. So we got a little off topic there, but important because a lot of
information.
Yeah, I mean,
Nobody
a
wants
lot
to
of
pay Uncle Sam.
Yeah, exactly.
But I will legally.
But
I'll pay what is required of me.
Exactly, but you want to pay as little as possible,
exactly.
Right? That's the point. So, but yeah, so I guess my point is there's a lot of like really, really similar ETFs. So like I said, the VOO and the SPY, those are two that are like essentially the same thing. They track the S&P 500. So they're going to have very similar holdings. If you kind of pulled up, like, if you had like two screens, you know, like the dual screen action, and you pulled up like the Morningstar page for VOO and you pulled up the Morningstar page for SPY, they'd be like carbon copies of each other. So that's something that you can do, I guess, if your investments go down. You can do it too with like single stocks. So like, for example, like, I'm trying to think, maybe if you have two bank stocks, one goes down, like say you own JP Morgan, it goes down, you could buy like Wells Fargo. Again, very similar, same industry, same kind of company. And then you could, you know, tax loss harvest between the two of those. Again, this is not advice by any means to go out and buy like JP Morgan or anything like that.
Does it have to be the same sector or no?
Yeah, you want it to be as similar as possible. Like you want, in a perfect world, you would just buy the same stock, but there's like rules against that. And also the other thing too is it has to be, you have to hold the stock you sell, you have to have held it for a year or more. Otherwise it's considered, or I think it's like 30 days, because otherwise it's considered a wash sale, and it's like different rules apply to that. And I'm not going to get that. I don't really know about it, but yeah, you want to avoid like just like churning, you know, holdings and stuff like that, because you generate a lot of short-term capital gains and different shit. So
Sort of just day trading.
Yeah, DDTG. But yeah, I mean, I don't know. I've been talking a lot, I guess, just kind of making it up as we go, but no, not really.
Bro.
But all of this shit is like legit. We're not
definitely, bro. Yeah, we're
Um,
absolutely out
yeah.
here spitting facts. No, but what do you look for? And you don't have to get into like your specifics, but what do you look for when you're looking to invest in an ETF?
Oh, that's a good question, and I'll tell you, um, it's it's kind of a little obscure, and I think a lot of people wouldn't think of this. Not to pat myself on the back, but if you're kind of like
Warren
financially,
Buffett.
yeah, no, not at all. But if you're kind of more financially savvy, which we hope we're kind of making you guys more financially savvy, you're gonna want to like look through. First thing I look at, let me just go with that. So first thing I look at is like, say I'm comparing like the VOO and SPY. I keep coming back to that because they're pretty similar, but I'll look first at like expense ratio. So expense ratio is just going to eat into my return
Right.
regardless. Like every year they're going to take 40 basis points, which is like 0.4% of my return, regardless of if it goes, well, I think only if it goes up, it applies because you can't really, regardless, they're going to take it every year. Just go with that. So if I can minimize that, that means I'm going to therefore maximize my return.
Mm-hmm.
So that's number one. Number two is I'm going to look at, so I'll go, if I go on Morningstar, actually maybe I can share my screen and I'll kind of like walk through it. Will that work, Willis?
Yeah.
Okay. Oh yeah, here we go.
I'm
Oh
posting this
yeah,
on the tube.
getting into it.
Yeah, they'll be able to see it still.
All right, so let's go here.
Well,
So we'll go
unfortunately, if you're listening on Spotify, you won't be able to see this visual.
right. But basically I'll just kind of talk through it. But yeah, if you want to see the visual and kind of follow along, check us out on YouTube. So let's go VOO. So basically I'm looking up the ticker. This is the Vanguard S&P 500 ETF, the VOO. Talked about this already. So Morningstar is really good for like informational purposes. It doesn't give you a ton of like guidance or like projections or anything like that. They're not really good at that, but they do have a ton of information and a lot of it's free. Some of it you have to pay for, but regardless. So I'll go price first. That's number one. And you see this only has a 0.3% expense ratio. So that means if the fund returns 10%, I'll only end up getting 9.97% of that return because they're going to take that expense ratio. And that's just for them to
manage the fund.
Yeah, manage the fund, exactly. Because they do have to, like, remember this tracks the S&P. So like, say a new company gets added to the S&P, they have to like adjust their holdings.
Mm-hmm.
So that's what they do. Then, I guess after price, I'll kind of like look through all this, and make sure it all like looks pretty good. This is really, really low, but that's because it's a passive fund. So nobody's like actively trading the stocks in there. I guess next I would probably go to risk, or maybe I'll look at portfolio here, and I'll just kind of look at their holdings. So obviously this one's pretty self-explanatory. It's 98% U.S. equities. That's pretty obvious because the S&P 500 is U.S. companies. But you can kind of look at different, this is what I'm talking about. There's so much information on here. But
Is
yeah,
this
so
one of the primary resources you use when you're doing your investing information?
definitely, yeah. But yeah, so there's a bunch of different kind of valuation metrics here. It's broken down by sector. So like, obviously this is going to match up pretty well with what the S&P 500 is made up of. A ton of tech stocks. They're really on the rise right now because of like COVID and everything. Healthcare is pretty high too. So this is what we were talking about earlier. So if I buy this fund, that means my exposure to tech is going to be really high, comparatively speaking, as opposed to something like real estate, which is only 2.8% of the fund.
Yeah.
Then you can kind of compare it against the category. So going to be really similar here because all the funds kind of have to hold the same thing. Sustainability, that's what you were mentioning, TC, like the environmental. Yeah. If you're kind of interested in like ESG funds, so environmental, social, and governance, those are like kind of more like, I don't want to call them progressive, but like, you know, companies that look out for the environment or like, you know, social problems, whatever. They're like interested in those. You can look into that yourself if you want.
Yeah, they also have like for Black businesses, they have like ETFs on that, I believe.
Yeah. Yeah, that's what we're saying. Like there's so many of them and you can get into the weeds really, really deep into this stuff. And it's crazy. But then they kind of break it down by company. So you can kind of see, look at the top holdings: Microsoft, tech, sort of, Facebook, tech, Alphabet. Like there's so many tech stocks in this. But that's just what the index is made up of, so they have to hold that. But yeah, there's a bunch of other shit on here. I'll usually go portfolio next, and then maybe I'll look at risk and performance kind of like hand in hand. Because it's not great to, like with this one, it's a little bit different because it's an index.
Right.
And, you know, it's just going to basically return anywhere from like 6 to 8% every year.
Right.
Like clockwork. On average. I shouldn't say that because, you know, like you can kind of look back here, but if you kind of average this all out, and you'd figure out like it's about 8%. Yeah, I mean, there's other stuff on here, trailing returns, the star rating. That's kind of dumb because that's like a Morningstar thing. I don't really pay attention to that much.
It's just somebody's opinion.
Yeah, I mean, they just kind of rate funds, and it's like, it's dumb how they do it. But yeah, so let's look at another one. Oh, let's look at Jets. We mentioned that. I know I'm kind of going like long here, but this is like good stuff. This is really relevant to retail investors.
Big fan.
I saw a stat the other day, and I wanted to get your guys' opinion on this. I was talking to a member of my firm, and they told me something like the average retail investor has returned like 1.5% or like 2% on average for the past like whatever 20 years or something. Because somebody brought up like all the day trading that's going on. That's pretty popular right now. But I wondered like what you guys thought of that.
Of the fact that people are only getting 2% return.
Yeah.
Yeah, that's not really the best return.
Yeah.
I mean, you get a better return just having your money sit in the high yield savings.
Right.
For 2%.
Not right now, though.
What was that?
Not with interest rates this low.
Oh,
yeah, that's true. But I mean, even like you could just buy the VOO and just pour your money in there, and you're still going to get on average a better return. So it's just crazy. Like I think that's what makes like our discussion tonight like so valuable, is the fact that like this is an easy way to make good return and like not have a lot of work involved. Like, I mean, we're going into the weeds a little bit, I guess, but you can just buy like VOO and VTI and be set for the most part. I mean, obviously you want to talk to your financial planner and everything like that, but still, I mean, if you're doing like a little retail investing on the side and you build that core kind of like ETF portfolio, I mean, there's no reason that you should only get 2%. That's like atrocious.
So why do you think it is that everybody's starting to day trade now? Is it you think it's because it's like a get rich, like people think they're going to just hit big and try and catch a hit stock or something?
Yeah, I mean, first of all, it's because there's no sports. So a lot of people who
I read there's like a ton of new Robinhood investors.
Yeah, so like from what I've read, and you guys can like jump in whenever, but there's a lot of different things. Number one is there's no sports, so all the people who normally would gamble on sports are just getting in the stock market because it's like they think it's like a casino or whatever, or it has that appeal to them, I guess. Number two is it's super easy to trade. Obviously, like there's no more commissions are like not even a thing, so there's very little like friction there. And then obviously like Robinhood and like Acorns and all these other ways for people to get into the market just by downloading an app.
Right.
And then number three is like people are just bored as shit. So like trying to get into stuff, like I said, no sports, it kind of goes along with that. But people like are just putting money in, trying to make, a quick buck. And then there's a lot of people like,
They're trying to flip them stimmies.
yeah, well, yeah, you're getting a lot of money too, if you're unemployed. But yeah, I mean, I don't know. What do you guys think? What do you think about it?
I think it's also like the gamblers. It's just another form of gambling for them. And just the market's pretty unpredictable right now. So people are just throwing money in, trying to see if they can make some quick money.
Yeah, that's true too.
Like electric vehicles, shit's going crazy right now.
Bro, Tesla.
Yeah, Tesla is going nuts.
Even like the small ones.
Yeah,
like,
I heard that company, Nikola.
Yeah, that one.
Nikola.
They don't even have any revenue, no products.
Yeah.
This NKLA.
Yeah.
Yep. Hybrid trucks. Yep.
Bro, I seen some of them. Them look sweet.
Yeah, but that's the other thing too is like, that's why I think what we're doing is pretty valuable is like a lot of people are getting into this shit and they don't know what's going on. And you can really like I said, average retail investor returns 2% per year. And that's not even like, that barely outpaces like inflation. So basically you're making no money in real terms because all your money just like gets inflated away.
Yeah.
Prices rise, et cetera, et cetera. So yeah.
Bro. Yeah, man. That's why like I've been trying to learn more about value investing because that's really what's going to matter over the long term. If you start thinking about like the long game is holding valuable companies that are going to be around. And I think that's why tech is starting to get really hot is because we're only getting more and more advanced in technology. So it's like that's gonna be kind of like how energy companies and stuff like that were big, kind of like GE and stuff like that. So yeah,
definitely. Yeah, I would agree with that.
I just obviously don't take my advice. I feel like we're on like a kind of like a bubble for the electric vehicles. Kind of like
like Tesla.
Yeah.
Like,
what is it at now? Go to it because I heard it had fell a little bit off its high.
Yeah, 14.9. Damn, that shit collapsed.
I think it was at like what?
Bro, they said 40,000 people on Robinhood had got into Tesla today or something like that.
Damn.
Because they have fractional shares.
Yeah, that's the other thing too that we didn't mention was the fractional shares are huge.
Yeah, because now you can own like Amazon or partial of it. You'll have exposure.
Yeah. But again, this is like kind of in comparison to that, getting an ETF is like, I would say, in my personal opinion, I would say it's better because you risk around. Not only do you get to buy like a Tesla or Amazon, but you spread your risk around at the same time. So
yeah.
Is there
I didn't know that shit.
ETF?
Probably. Let me see.
Probably. I'd say that's safer than just buy one of the stocks.
If I can spell it. Utilities. Oh, and then, we didn't even get into this. There's other things that are like leveraged ETFs, and that gets like super deep into it, which I don't think we should touch that today because it's pretty crazy. But basically, they just like lever up and like increase the return, but it's more risky, obviously. But let's do that. Let's jump back to this because we kind of got away from it, but that was good that we did. So again, hitting the price tab first, checking that out. You see this one's a lot higher.
So you
That's
would see 99.4 or
yeah,
90 point, or which one would that be?
no, 9 point. So like if it returned 10%, you would get 9.4%
Okay.
return. Yeah, so 0.6, a little bit higher. I think this is active. I'm not really sure, and that's kind of embarrassing because I own it. But anyways, so we look at the portfolio and see it's a little bit different. So you can kind of see the different like categories that it's in. So this is a sort of mid-cap value fund right on the edge of like value and blend.
And
So
cap stands for the capitalization, right?
yep, yeah, mid. So mid is like there's different ways to define it, but small is usually like 2 billion in market cap and under. Mid is like 2 to like 10, I think, and then large is like everything above that. But double check me on that because I'm not sure if that's right. And a lot of people define it different ways. But then again, you can see like different asset classes. This holds a little bit non-US, actually a lot of bit non-US, and then they hold a little bit of cash too. Again, valuation metrics. But then, so look, this is what I'm talking about. They don't hold anything except for industrials, which is airlines. So this is where you can kind of compare
The
different
diversification.
sectors that you want to get into. So I would hold. So if I invested in this, I would be 100% exposed to industrials, which is healthcare, or healthcare is airlines. Other shit, and again, that ESG, it's kind of important if you're into that. And then you can see the holdings. So Southwest they hold 10% of, or their portfolio is 10% Southwest, 9% Delta, and then a bunch of other airline stocks. So this is part of the reason that I kind of was interested in this, because you can look at the 1-year return. And this is where I was like, okay, so back in March, we kind of saw the market tanked. Most of the things that were hit were like airlines, hotels, like entertainment stocks. Yeah, cruises. So I was like, okay, to me, that's like an opportunity, because it's like, okay, they're way below obviously they dropped off a lot. So, buy low, sell high, that's kind of the point. But I was like, okay, do I want to go through and research all these companies like Southwest, Delta, United? I don't want to do that. I don't like have the time for that, and like I just don't want to. So I'm like, all right, let me look up and let me see if there's an airline ETF. So I looked up that shit and I found the jets. And I kind of looked at the price, looked at some different things, and I was like, all right, that's cool. This kind of gets me what I want. I spread my risk around. So even if one or two of these goes bankrupt or loses a ton, the other ones are most likely going to come back, because airlines are pretty much essential at this point. And, so the ones
There's no electrical planes.
right, yeah, exactly. So the ones that come back are going to more than make up for the ones that go down. I might not make as much as if I just picked cargo jet, which I never even heard of. But if I just picked cargo jet and I made like whatever, 70%, I might only make, 15. But still, I have a lot less risk, and I don't have to do all the research of like, let me look through their balance sheet, cash flow statement, whatever, of all these companies. So that's like how I kind of came on to this Jets. But I mean, there's nothing special to it. You just kind of have to know what you're looking for. But yeah, you can kind of see that year to date, 50% down.
So that the year to date metric that tracks from this day last year.
No, year to date would be like January 1 to
1. Okay.
Yeah, 1
Year over year is the way I just explained it. I think I was talking to my brother about that the other day.
Yeah, year over year would be like July of last year to this year.
Yeah.
That's year over year.
So year to date is since January 1st.
Yeah, 1/1, whatever the year to today.
Down 50% when that Rona struck.
Yeah, and I bet if it's like month, yeah, if we go month, there's gonna be like a huge. Oh no, this is different year trailing returns. I wish I
Yeah,
could
if
see
you
it.
look at it on like a chart, that's why I mess with Webull, because you can look at the actual chart,
Oh, okay.
like
Yeah,
on a trading view.
yeah. Obviously, in March, everything kind of went like this.
Yeah.
Straight down. So
On like any chart you look at, really,
yeah, for real.
no matter what it is. And
Straight.
that's not true. But most things went down in March.
Most things did go down. That's why they say like in a recession, correlations go to 1 because everything goes down.
Yeah.
Could have bought the I think it's VTX, the inverse of the S&P
Oh yeah, VTX.
when Corona started. It might not be.
VTX. Let me just look up inverse. Inverse. There you go, RIDEX. Inverse S&P strategy. So this is what I was talking about, like the 3 times levered. It's a little bit complicated, I guess. But again, like, see, so this is Willis. This one has an expense ratio of 1.79. So that's obviously because they manage the fund a lot. They have to make a ton
More
of
active.
decisions. Yeah, they're constantly like trading different things and like, okay, this fits, okay, this doesn't, et cetera, et cetera. So therefore has a higher expense ratio. So if this is something you're into, then you could, do a little bit of research on it. Oh, except for you have to have a minimum initial investment of $2,500. So unless you just have that lying around.
So is it often that you'll find ETFs with a minimum balance?
I don't think so. This is the first one I've ever seen. So
Or minimum investment? Same thing.
yeah, potential capital gain. I don't even know what this is, honestly. I think just because it's an actively managed, like they have to do this or they have this involved. So I guess we could kind of break down the naming conventions of these two. So RIDEX. So when you see something like this, RIDEX, if I'm not mistaken, it's going to be like the managing company. So RIDEX Funds, which is a part of Guggenheim Investments, I guess. They're going to be the company that puts this fund together. So, wait, where did it go? There we go. Oh, get this thing out of the way. So that would be the company, and then this kind of details the name. So, like you said, Will, it's an inverse of the S&P. So I guess, let's see, we can go here. Oh, not currently covered.
Go to VXX. I just looked it up.
VXX.
That's the Vanguard one.
This one here.
Yeah, maybe it should. Yeah.
VXX. Yeah, must be. All right.
Yeah, it is. It's not Vanguard then, but
yeah,
it's the inverse.
Yeah. So again, like this is going to be the company name. This is who owns the fund, or I guess the investors kind of own the fund, but this is who puts the fund together. And then it'll kind of tell you a little bit about like what the strategy is. So like on that last one, it kind of said like inverse S&P 500. That means that it owns like the opposite of the S&P, which I don't really technically know what that means.
So I kind of know a little bit.
Okay.
And
Yeah,
so like
go
with
for it.
Corona, the S&P dropped down, that stock went up to like 50 from like 25.
Okay.
So when the S&P goes down, it's going to go up.
Okay.
I don't know how it does it, but it does the opposite of whatever the S&P does.
Right. So this could be like a good way to like hedge your bets a little bit.
Yeah.
So you could own both, you know what I mean? And then they're going to kind of move in somewhat opposite directions, depending on if it's a good manager or not, if they hold the right things. but that's a way to like make money either way. So if it goes down, my one fund is going to go up, and then if it goes up, my other fund is going to go up, but my one fund is going to go down. My inverse fund is going to go down. So a little bit of hedging strategy there. Again, not advice in any means, in any way, shape, or form, but just like kind of something to look into, I guess. So you can look at parent here. Yeah, so the firm name is here. Market, US ETFs. There's just a ton of information. Morningstar like kind of gives you a little bit of an overload of information, but if you kind of look through it, just kind of take your time and go through all the different tabs here. There's a lot of good stuff for sure. Yeah.
So would you recommend beginning investors to just kind of stick to the main, like the bigger ETFs?
Yeah, I don't want to like classify it as a recommendation just because like people, can misconstrue that. But I would say if you're new to investing, I would definitely look into ETFs. I'll put it that way. So like ETFs are a really good tool, regardless of like your level of expertise, but especially if you're new. So I'll put it like that so nobody takes it the wrong way. But yeah, I mean, it's fun talking about these things. There's so many of them. You can look into so many different companies, like asset management companies have these. Like Vanguard's a huge one. They have a ton of different ETFs. Schwab has a bunch. iShares has a bunch. I think State Street has a good amount of them. But even like, I don't even know what this iPath thing is. Actually,
yeah, I've never heard of that. Other than
yeah, but
stuff.
So like, yeah, man, I could talk about this shit all day. Let me stop sharing my screen here. So hopefully everybody found that like useful. I know I took a ton of time. What are we at, Willis? Probably like 45 minutes or so.
Can't see.
Oh, okay.
No idea.
I think so.
I think it's been about 50 minutes, hour.
Yeah, on my timing. But like, there's a lot to cover. So we didn't even get into like those like specialty strategies that I mentioned. Like there's 3 times bull. It's called like 3 times bull market strategy, which is like when the market goes up, you're going to generate like 3 times the return, but also on the other end, you're 3 times down when it goes down. So it's like levered ETFs. There's like, obviously, like we kind of saw a little bit the inverse ETFs. And then obviously like all the different sectors you can get in, you can get blended, like different sectors, you get indexed, like there's just so many of them. But I got to shut up because like there's too many to talk about really. But we just wanted to give you guys some basics. So hope that helped. TC, you got any closing comments?
Yeah, man. I mean, I think it's just important to, especially with the industry and the world of finance, just to take bite-sized pieces because it can get very, very intricate. So just introducing yourself to like a genre and then doing your own due diligence and studying like say we're covering ETFs. So we kind of gave you guys some good basic information to go and kind of research further and then find things that, also coincide with ETFs. So that way you're just learning more and more and just kind of compounding that. Definitely. But yeah, I think ETF is a good way to start to get invested. Yeah.
Yeah, I mean, like just to kind of like go off of that and then I guess like close it out is like the point that we're trying to make is like the point is to get invested. So like the number one thing that determines like investment returns is like your time horizon. So if I invest for like 5 years, I'm probably, unless I like really like fuck it up and do like a bunch of dumb shit, I'm probably not going to make as much money as somebody who's invested for 60.
Right.
or actually I said that wrong. If I'm invested for 60, I'm probably going to make more money than somebody who's invested for 5, just because of the power of compounding. And so if, especially at like our ages, we're only like in our 20s, so we have a long time horizon, and that means that we have a long period of compounding returns. So anybody who's like kind of listening to this and thinking like, I'm in my 20s, maybe they just graduated, or like, they got their first job, whatever. The point is to just get into the market, and then at that point you start like evaluating different strategies. So like we're giving you the option of like using ETFs as a powerful tool to get invested. So I guess what I'm trying to say is the point is to just get into the market, like get into the market, and increase that time horizon that you have of investment returns. And then one easy tool to use there would be an ETF. Again,
sure.
Not
a
recommending.
vehicle.
Right. Yeah. Not recommending one way or the other, but yeah, it's a great vehicle to drive the investment road in.
Drive to financial freedom.
Yeah, definitely. So that about wraps up the ETFs and the finance section in general. Hope you guys found that helpful.